All right, let's jump right into it. Today, we're breaking down a trading plan that's built on one single, really powerful idea: radical simplicity. We're going to distill a pretty complex strategy into a super clear, actionable guide that's all about focus and precision above everything else. Let's get to it. So, does this look familiar? You're juggling a bunch of different currency pairs, staring at charts for hours on end, and just feeling totally swamped by information overload. You are definitely not alone. So many traders burn out trying to be everywhere at once. This plan, though, it offers a completely different path.
So how do we fix this whole mess? Well, the core philosophy of this entire plan is what we're calling radical focus. It's all about finding that clarity and consistency, not by adding more stuff, but by dramatically simplifying your entire approach to the market. This really redefines what mastery even means. Instead of knowing just a little bit about a lot of things, the goal here is to know absolutely everything about one thing. The author of this plan literally trades just one pair, Euro-USD, for only 3 hours a day. The idea couldn't be simpler. Become a true specialist in a single pair during one specific market session. Real expertise you'll find comes from depth, not breadth.
Okay, so we've narrowed our focus. Now it's time to actually learn the language of the chart. Think of this next section like learning to read a map. We have to understand the key landmarks of price action before we can even think about finding our destination. First things first, market structure. You can think of it as the backbone of the chart. It's that series of peaks and valleys, the highs and the lows, that shows you the market's main direction. And trust me, trading with this underlying current is just way safer and a whole lot easier. It's the path of least resistance. But here's the thing. Not all highs and lows are created equal. This is where we have to learn to tell the difference between strong points and weak points. A strong low, for instance, is one that had enough power to actually break a previous high. A weak high is one that tried, but failed. Identifying these tells you which side, the buyers or the sellers, has control, and which points are likely to hold or just get blown right through. It's all about figuring out who's really in charge.
Next up, we have supply and demand zones. And you can forget all those complex indicators, because these are the raw footprints of institutional money. These are the exact price levels where a huge, imbalanced flood of orders came into the market, pushing the price away aggressively. Smart money traders see these zones as super high-probability areas where the price might just turn on a dime.
So how do we spot a good zone from a bad one? Well, this plan has a very strict three-part checklist. Number 1, the move away from the zone has to be so aggressive that it leaves behind a price gap, what some call an imbalance or a fair value gap. 2, that same aggressive move has to break market structure.